Ladies and gentlemen, good afternoon to all of you, and including those who are tuning in online. Welcome to the Distinguished Speaker Series seminar organized by the Hong Kong Academy of Finance. My name is Howard Lee, one of the Deputy Chief Executive of the HKMA. I will be having a very interesting fireside chat with Jenny with me today. Now, for those who are not familiar with the Academy of Finance, it's really set up with an objective of promoting sharing of knowledge and supporting development of leadership in the financial industry. So we have a series of distinguished speakers series through the years, and very often depending on traveling schedule of financial heavyweight like Jenny. If they happen to be in Hong Kong, we eagerly grab them and then come to offer a talk for us. So we are very happy today to have Jenny with us. Now, I think everyone knows Jenny, but still by way of a little introduction, Jenny has spent 30 years in Franklin Templeton. She has held a leadership position in the different roles through the years. And since becoming CEO in 2020, she has overseen a number of high-level acquisitions, including Legg Mason, including Lexington Partners. We're going to talk about her philosophy about that as well later on. And more recently, Jenny has spoken a lot about technology and innovation. And in my previous dialogue with Jenny, I can feel her enthusiasm and really commitment about the use of technology and the deployment of technology in different ways in the financial industry. So our seminar today is in hybrid form, just like what I explained. We have around 60 attendees here. Because this is a small space, we cannot accommodate so many, but we have, I was told, some 600 people online watching. And this is going to be recorded and also put on the AOF website as well as a YouTube channel so that people can revisit and can review later on. Okay, without further ado, let me turn to our discussion. Now, Jenny, maybe more general topic first about the macro issue. People talk about we are facing a different world in the sense that interest rate environment has become very different. We have a geopolitical backdrop. We have aging demography. We have AI. A lot of inflection point. And so as investor, as manager, what do you think that we should be concerned about? How do we position our investment going forward in light of these changes and macro trends?
Well, first of all, I want to just thank HKMA for inviting me. It's an honor to be here, and of course, Howard, to get to be interviewed by you, so thank you. You know, I think the first thing is that we have just come off a decade of kind of easy money, and honestly, if you didn't make money in investments, I don't know how you lost money in investments. Cash was zero. There was nowhere to put it. You put it in the equity markets. They kept going up. You put it in the private markets if you could. And it was more about whether you earned your relative position versus others, right? But now we're in an environment where I think from a geopolitical standpoint, we're all aware of the tension between US and China, the two wars that are going on, you know, the cost of oil and the impact. All those are factors that are now going to play into how you have to think about it from an investment standpoint. And so I think that it's really going to be a time, and look, I'm going to pitch my book, which at Franklin Templeton, we have $1.6 trillion in management. And we really focus on active management, so that's risk-adjusted management. And, you know, I think right now we're going into a decade where active management's really going to matter, and you're going to have to be looking at bottoms-up, evaluating individual companies as well as a top-down macro view. And I think there's 5 kind of key trends that you have to think about how you navigate those. And so they're, because I have to be able to remember them, they're all starting with D. Demographic, deglobalization, I'll call it deleveraging or disinflation, digitization, and decarbonization. So in the demographics, you've got regions like Asia where you have, they're talking about some portions, some countries have very young people, and so that's going to be a great tailwind, provided you can educate them, provided they can be productive, and so that's going to tax certain things. And then you have populations that have an aging population, and that's going to be a drag potentially, but investment opportunities in things like life sciences, obviously, so you're taking care of an aging, population, but a drag on really requiring the younger population to support them. So you have to, think about that trend. In deglobalization, I mean, it's interesting. It's the China plus one story, but as I talk to folks who have been looking at their supply chains, the China plus one is not with China, right? So you're taking somebody who's manufacturing in China today, they're moving their final assembly to another market like a Vietnam or in Indonesia or in India, and then you can say made in Vietnam, and then you get around the US tariffs, right? So that is clearly an opportunity, but by the way, a benefit really. I think a lot of people think of that's more of a headwind for China, but probably not. But then who are the beneficiaries, right? So you can think about that. I think on the deleveraging or disinflation, first of all, that China plus one story is inflationary, if you think about it. I mean, people manufactured in China because it was the cheapest place to do it. And so now that you add another layer, that's going to be inflationary. And so as governments are dealing with the debt that they've taken on because of COVID and post-COVID, they're going to have to figure out how they're going to manage through that. And you look in the U.S., I think the market's overly optimistic about rate cuts this year. If they happen, it'll be towards the end of the year. I think it's going to be much harder for the U.S. to get inflation under control. Now let me just be clear, we have a few different fixed income teams and they all have different views, so I'll say that's my view. But I think it's going to prove to be harder to really control the inflation. Digitization, look, you're starting to see, which is pretty interesting, productivity is finally, you're seeing an increase in productivity, which is, by the way, disinflationary. So maybe that can offset some of the inflationary wins. My instinct is, a lot of people are talking about AI. I actually think we are so early in AI that you haven't seen that in the productivity numbers. But they will also come into the productivity numbers and be very significant. But it's really a lot of the technology that has come over the last couple of decades that are starting to get infused into production and creating efficiencies. So I think that the digitization is going to be a great opportunity from investments. And then finally, decarbonization. You have governments that represent 90% of the world's GDP saying that they want to hit net zero either by 2050, 2060, or 2070. All of that, it requires massive amount of investment, and there's going to be investment opportunities there. So I think if you think, those are like the broadest cross-cutting trends, and then if you go in and actually are selective, I think you can find really great investment opportunities.
I see. Now, you mentioned AI. Now, recently, I think we cannot end a seminar or fireside chat without talking about AI. So we might as well deal with it up front.
Go for it now. Get right in, dive right in.
And you mentioned AI, but now you look back, AI, of course, after the ChatGPT, more focus on AI, but AI has been in place for so many years.
Yes.
And I guess your firm might have been using AI for decades. So is there really a watershed of ChatGPT bringing to the table? Or I have also heard that the Gen AI, while it's very interesting, very impressive, but the business value to a corporation has yet to be really uncovered. So what's your take about AI and Gen AI? How's your firm positioning yourself to really maximize the benefit or reap the benefit of these advancements?
So I would agree that it's been around for a while. I mean, we've used machine learning to create quant models and do selection on loan purchases and things like that. But what happens when you have something like a ChatGPT, it's just like the internet browser. It suddenly made all of us understand how powerful AI is. And that's when you start to unlock creativity and start putting resources in it. So now, post ChatGPT, every company has their chief AI officer, whatever you want to call them, and are trying to buy and acquire resources to be able to leverage it. Now, I do think that generative AI is really significant and has the ability to add tremendous efficiencies, but generative AI is like the kid who gets the A in the English class but fails the math class. It cannot deal with numbers at all. You have to use different models to be able to do that. And where you're going to start to see the great leaps is when people start to combine models. So one of the things that I know our investment teams are working on is imagine that you've been an analyst covering companies and you've got 15 years of research reports that you've written up. You've got a library of sell-side reports. You've got a bunch of data that's out in social media, and you want to do a query of something. Please tell me the trend, whatever. A generative AI can't add up the math in those reports, but when you combine generative AI with other models, you can actually think of how efficient that answer can come out, to an analyst who's looking at something. And oh, by the way, it's going to add a bunch of details by being able to gather information that's out in social media and other sources to be able to inform you about that company. So, there's going to be really powerful breakthroughs that ultimately happen, but we are just at that stage of, trying to figure out exactly how to do it. And I don't even know if there's all that many skills that have yet, as far as people graduating with everybody claims to be it, who was a data scientist, but from my understanding, it's quite a bit different than that. And if you just look at things like people who use GitHub, which is a programming open source site, there's a co-pilot in there that they're actually getting the generative AI to code 50% of the code that they're doing. Now, our technology team would say, now, we don't think that code is good enough yet, but it is great at documenting code. So if that's one of the things that as you programmers do, you need to be able to document what it's doing. And now that can be done as the programmer goes along. So there's going to be massive amounts of opportunity to leverage it, but we are so early in that I think, and anytime new technology comes in, the first thing that people do is you just become more efficient at what you do today. You don't make the leaps with creativity until later. And we're just at the stage of figuring out how to be more productive today with generative AI. But down the road, you'll see big leaps, I think.
Well, just like whenever there's a gold rush and people have a vision of getting gold and in the gold mine, but very often those who are going to the gold mine would be the last to get rich. The first to get rich is those selling the tools and then hotels and services. So now we see NVIDIA and everything. So we are waiting for companies or corporates to really hit gold in the Gen AI, right?
That's right, but the picks and shovels, the store owners of the picks and shovels in the gold mine made a lot of money, right? So, if you're running data centers or you're a chip manufacturer, there's going to be plenty of opportunity for investments to be able to find investment opportunities to be able to support this AI trend. But I think it's also the efficiencies of businesses. I know our team built a bot to respond to help desk desktop queries about, I need to change my password on my computer or whatever it is. And the bot is answering 100% of the queries and retiring 60% of them in the first round. So, that used to be people answering those things. So as companies figure out how to leverage this in their environment, they're going to be able to increase their margins, invest in other things. So there's going to be great opportunity there too. It's not just going to be the picks and shovel investments.
Okay, that's good. Now let's continue to stay on technology, but on a slightly different topic. And you also talk extensively about using technology to disrupt the industry and how do we digitize financial asset, and you your firm actually launched a Bitcoin spot ETF. So how do you see this kind of trend going forward? Is it really just a hype and that will go away, or you see that a lot of traditional financial activities migrating to tokenized digital form going forward?
So I think you have to separate Bitcoin from blockchain. So it's really important. So our Bitcoin ETF, you either believe in the Bitcoin story or you don't, right? And if you believe in the Bitcoin story, then it's a way to access it that isn't as complicated as having to remember some long key that you would have to do if you were going to actually go in and do a raw acquisition of Bitcoin. So it was just being able to open up the market and access it. From a blockchain standpoint, we think, and when we built this, or we launched this tokenized money market fund, so it's SEC approved, 40 Act, we built a transfer agency, so the shareholder record keeping system on the public chain, on the Stellar network, and we have a hot and cold storage wallet. And we've been surprised at how cost effective that technology is. We used to run our own in-house, we had 4 different transfer agency systems, all on different technology. This one is so dramatically cheaper to be able to operate that we think there's going to be really interesting opportunities to be able to bring new types of assets to an investor. And so that's why I'm so bullish on blockchain. It's going to drive out costs in the system, and that's going to be painful, right? Because today you have a lot of, I'll call them toll takers, people who take a little piece of money as a transaction goes through. If you buy a house in the United States, you have to go to a title company and pay them to prove that the seller has the right to it. But if you have something represented by a token, all that ownership and everything is already in the transaction as it occurs. You don't have to get validation. So if you can drive out costs, you can actually reduce the size of transactions. So the way I think of blockchain is, if you think about securitizations, right? They took cash flows, or they took, if you had a pool of loans or whatever, you could securitize, and that opened up a whole bunch more lending. In the United States, mortgage-backed securities and securitizations massively increased the amount of home ownership. Well, now, if you can drive down those costs, it's my favorite example on blockchain, which is blockchain does 3 things. It enables a payment mechanism, it enables smart contracts to execute all the rights on that transaction, and it has a general ledger, so you have a proof of ownership. So Rihanna, the singer, launched 300 NFTs, each one worth 0.00033% ownership or royalties to one of her biggest hits. Why can she do that? Because when the streaming service plays her song, your fractions of a cent, of a penny, or whatever, are getting paid. The smart contract kicks off and recognizes that if I have the token in my wallet, I have all the rights to that, so I get paid. You could never do that before, because there were too many people that had to be involved in that transaction, so you wouldn't be able to do fractions. It wouldn't make sense. It wouldn't be cost effective. And so we think it's going to open up a lot of different types of investment opportunities, and you already see it today in the crypto space, that will be interesting and legitimate. Now, I think, to Hong Kong's credit, they've done a wonderful job on providing a certain amount of regulatory clarity for those who are interested in leveraging blockchain as a technology. It has been more difficult in the US. We've worked a lot with the SEC on it, and it's challenging, right? Because if you've got a token inside a game, is that a security versus a token that holds royalties to a song? And so, this is blending things that historically you had very separate. And I think that creates a certain amount of challenges in the space. But there's no question in my mind that I'm very bullish on the opportunities that blockchain is going to bring.
Well, I think you point out a very important issue in the sense that a lot of these activities, new forms of financial transaction or asset tokenization, sometimes they live in the kind of unregulated area, a little bit of gray area. That promotes innovation, allow a lot of creativity. But when it wants to come to mainstream, without regulation, without control, it also brings in other problems. But over-regulation will stifle innovation. How should we strike the balance? When do regulators come in at the best time? So we allow it to flourish and then starting to become mainstream and come in, or we set the sort of a rule of the game at the outset and then let it play out and then to protect consumer. What's the approach that would best fit the development?
So I think the challenge has been if you overregulate, you're exactly right. You're not going to get innovation. On the other hand, if there isn't clarity around the rules and people are afraid that they're going to get in trouble, then they won't launch products and they won't innovate either. And so providing a certain amount of clarity and in these new areas, watching the market evolve and creating an environment for, to get feedback as that market's evolving, I think is really important. What are most regulators trying to do? They're trying to protect the consumer. Of course. Right? And so that's the goal. But that doesn't mean that you can take all risk out of an investment. The reason cash sits in a bank account and you earn much lower return is because it's got a lot less risk than another area. If you go into private equity, that's going to give you a higher return, but it's going to have more risk. So, it's not the regulator's job is not to stop any risk from the consumer. The consumer can take on risk, but to make sure the consumer is aware of what they're investing in, right? It's that transparency, and so that you can understand what risk, where some investment is falling on the risk profile. So I think that's the role of the regulator, is to ensure that there's transparency, to build a certain amount of protection around it, but it can't stop people from losing money. That is part of ultimately what happens when you make investments along a risk curve.
How do you find the knowledge of the investing public about these things? So when they invest in some novel products, do they really know what they are investing into, or they just follow the advice of a friend or someone on Instagram or Facebook? Because now we are dealing with a lot of technology projects as well. Now, my biggest worry is if we try to regulate something, but in a light-handed manner to allow more innovation, then it's tantamount to giving a license without regulation. And then the public would feel that, oh, it's got a license, it's regulated, so it must be safe, and then putting money into it. If it goes belly up, the backlash on regulated would be huge. Yeah. So either you say that it's not regulated or you regulate it like a bank. So that's sometimes my mindset.
Well, I understand the challenge, and there were obviously when FTX blew up the U.S. exchange, the SEC I think took a lot of heat and should you have regulated more? And it's a tough situation because it was sort of one of those things where they weren't regulating it because they were concerned about whether it was a security or not, and yet in the end they got that backlash. So I feel for the regulators on that too, and so therefore I understand in this space why there's a trepidation to regulation, because chances are something that's evolving this quickly as blockchain, you're not going to get the regulation exactly right the first time. Right. And there has to be a bit of a modification, but also be realistic, that you can't punish somebody who's trying to innovate, who stays within the rules, and there's always that sort of guiding principle. What was the intention? Were they being intentionally good and constructive, and then if you see things going off course, to say, all right, we need to tighten up these regulations. But I feel for the dilemma, because it is really hard in times of great change to be able to give that clarity around the regulation.
Right. Okay, thank you. That's very Very interesting. Now, maybe let's switch gear a little bit. We alluded to the kind of acquisition that Franklin Templeton and you personally made in the past years. So can you share with us a little bit of the thought process behind this? And also I noticed that for some acquisition after the merger, businesses are allowed to operate fairly independently with their own identity. So how do you derive the synergies in those situations? And what's your philosophy about sort of integrating culture and creating a stronger platform for the group as a whole?
Sure. So I would say first and foremost, so we've done 10 acquisitions in the last 4 years. Our view on acquisitions is it has to be part of a growth story. So we don't buy just for scale, to do cost cutting and take out synergies. We are buying because we genuinely believe this business was an opportunity to grow. And we have 3 big drivers that we focus on. So one was a desire to fill out product gaps that we had as a firm. And so in the case of like Legg Mason, we got, core plus fixed income is one of the largest categories that people invest in. I think it is the largest. And we got Western Asset Manager, a fantastic core plus manager. Then we also, the second thing that we looked at in our acquisitions was that there is a secular trend, we think, happening where companies are not going public as quickly. The banks aren't lending like they used to. And so you have this massive increase in private markets, private equity, real estate, and there's a desire for investors to invest in these private markets. And so we also got Clarion Partners, which is a big real estate manager with a Legg Mason acquisition. But we still felt we had other gaps. And we bought Lexington Partners, which is a secondary private equity firm, and Benefit Street and Alcentra, which were both private credit. So we saw those as gaps in our lineup of investment capabilities in what we believed are fundamental growing trends. And then the second area is things that help us with distribution. So most recently, we acquired Putnam Investments. Now, Putnam Investments is a fantastic equity fixed income manager, but more importantly, they had a big presence in insurance and in retirement channel. And in the US, we were pretty underrepresented in the retirement channel. And so it gave us distribution capabilities in those channels. And that's been really important for us to grow those channels. And then finally, we like local asset management because we operate in, we have clients in 160 countries. Any country that you operate in, people tend to invest in domestic products for 80% of their flows. And we wanted to have, we often look to buy local asset management. So that's kind of the framework that we had in just looking at the targets to acquire. And then what's important for us in the asset management business in acquisitions is that what are you buying? You're buying people in their investment process. And so don't mess with it because then you're going to destroy value. So we leave the investment teams to be very independent. And we always say to the CIO, they get to define what it is that is part of their investment process. So we have some teams that say, I must have a trader on my desk. Other teams say, I like trades executed in the local market. I want to use Franklin's global trading platform. What technology they want to use. Their research analysts are all independent within. So, we have multiple sector analysts because every team has their own sector analyst. We don't combine research in that. And then we combine at the platform level. So we have a global distribution. Client service is often within the investment team on the institutional client service. But things like risk management, we can overlay. But most importantly, on a $1.6 trillion platform, you have the ability to invest in things like AI. Data is incredibly expensive. And honestly, I think smaller managers over time are going to have a harder and harder time competing because they will not be able to acquire the data needed and the skill set needed to evolve with things like AI. And then we've been able to offer our clients, things like our Franklin Templeton Academy that does education because everybody has people that they need to educate, and so we can be helpful with that. And then we also have our institute to provide thought leadership. So this was a very deliberate strategy to basically have boutique investment capabilities with the scale of a $1.6 trillion manager to make those investments in technology, data, and other things.
Well, I think that makes a lot of sense. But I heard from so many people that merger acquisition has been extremely challenging, especially how to integrate the culture, how to really derive value out of it. So through this process and through these multiple acquisitions, what do you find was the biggest challenge?
Well, people often, I think the big question people have is, well, how do you really ensure culture?
Yeah.
And you know, what I always say is, look, the investment banker is going to tell you why it's a great strategic fit. They're going to tell you why it's a reasonable price, but they're never going to talk about culture. And deals live and die based on whether there's a cultural fit. And so we really do spend a lot of time on the Putnam acquisition. That was an 18-month sort of dating period of trying to figure out whether it made sense or not. And we spent a lot of time, in the case of Legg Mason, there were essentially 8 different investment teams. And we ended up feeling that one of them wasn't really a cultural fit. Now, he's been a tremendous friend of the firm, but it wouldn't have been the right fit within our firm. And so we allowed him we made a way for him to buy his company back, and we basically acquired the 7 individual firms. So I always say there's 3 things that I look for in people when it comes to whether they're going to fit in our culture. Do they genuinely look at clients first? Do they talk in their conversations about what it means to their clients? Do they feel like they're going to collaborate with people? Our greatest, I think, breakthroughs in the future are going to be where our investment teams find opportunity with each other. And I'll give you a couple examples of that. And then finally, in a time of great technological advance, this concept of continuous improvement, to never believe that you're finished, to always be looking for ways that you think you can do something better. And you have to have a mindset around that. And so that's what we look for. And you know, I can't tell you the number of deals because nobody ever talks about the deals you pass on, but there's a number of deals that we've passed on. And honestly, today we've gotten a very good reputation of being a good acquirer. And you know, they always pick up the phone, right? The company that we're talking to always picks up the phone of one of the folks that we've acquired their company and said, what's it really like? Tell us the truth. And the response has always been very, very good. And I will point out that we have doubled the size of Benefit Street Partners, Lexington Partners, and Clarion Partners since they came on board. And those are alternatives managers. Often people are skeptical about whether an alternatives manager can fit within a traditional asset manager. And you wouldn't have had that kind of growth were they're not a good fit. And recently the CEO of Benefit Street Partners said, you know, you bought us in 2018, and I always said it felt pretty good. You helped us with distribution. You know, people knew that we were in a good home. But now when I look at what's happening in AI, I realize we'd have a hard time. We could never do this on our own, and we'd have a hard time competing if we weren't part of the broader organization.
Right, okay. Thank you very much. Now, I'm talking to a very successful woman CEO and talking about culture, so I must talk about how do we sort of foster better culture in terms of diversity, inclusiveness. You have also spoken and demonstrated a lot of commitment to that as well. Anything to share with us in this regard? Yeah,
so it's funny because, you know, the U.S. had a Supreme Court ruling against affirmative action, and so there was a lot of discussion about, well, we don't need those D&I programs anymore, and then asking whether you'd keep them or not. And I said, we never did this because somebody told us to do it. We did it because we genuinely believe that if you get diversity of thought, you are going to get better outcomes. And the science is proven, and I actually have a friend who's a professor at UC Berkeley, and she's written a book called In Defense of Troublemakers. And the concept is that the devil's advocate never works. You don't actually get better solutions with the devil's advocate. Where you get better solutions is when you get 2 people in the room who absolutely disagree, because they will come up with every possible idea to prove their view is right. And that's actually when you start to have breakthroughs. And so diversity is diversity of ethnicity, it's diversity of socioeconomic, diversity of gender, right? It's diversity of perspective, education, all those things. And we just genuinely believe as a company that we will be better the more diverse organization that we have. We will just come up with better solutions for our clients.
I see. It's a natural fit to the two person will come up with better ideas.
Yes.
If they don't kill each other first.
If they don't kill each other first, that's right.
Okay. So coming back closer to home, I know Franklin Templeton is having Hong Kong as your base in Asia and the Greater China area. So I really thank you for bringing the whole executive team.
Whole executive committee's here, yes.
Here for a few days and
it might be a little jet lagged. I'm not sure. There could be a few sleeping in the audience, but I'm not going to take it personally.
Yeah, I pretend not to see it. And so what's your vision or your take about your business strategy in this area, including the Greater Bay Area, and then how Hong Kong can do better to support different financial institutions?
Sure. Look, you know, Franklin Templeton is a global asset manager, and we've been in China, or we've been in Hong Kong since I think 1987 when we first set up a research office here, and then this is our 30 years celebrating our client service group that set up here. And you know, we think it's an incredibly important market, and we think China is an important market. You can't be a global asset manager without being able to have a presence, we think, in both Hong Kong and China. And Hong Kong is clearly building themselves as the gateway to China. And things like the Greater Bay Area, I think it's called Wealth Connect, where you have 9 cities and the other regional ones being able to invest in each other's products. And we have products on those platforms. And so we just look at it as a tremendous opportunity for us as an asset manager to grow.
Okay. So cannot sort of talk about the Greater Bay Area without talking about China. And China stock market especially has been in the kind of pretty laggard compared to global markets for a while, including Hong Kong markets. So what's your take? And but China's still a major economy in the world, and in terms of global investor, it's inconceivable that they have no allocation to China. So what it would take for this to become a little bit better? Is people still worry about property sector, or what it would take?
So I think people still worried about the property sector, no question. I mean, the market's down. I think it's 30% or something, and you know, I think our emerging market team would say that our global equity team and emerging market team would say that, you know, it's as anywhere, there are still opportunities in the market, right? And so it's about finding those opportunities. And we've had our joint venture in China, I think we're 20 years now. We have a fantastic local team there in China doing both equities and fixed income, and they feed into the ideas and give us, you know, that view of feet on the ground. And so I think it's important to be able to find the right sectors and then the right companies in those sectors. And, you know, I think there were a lot of folks that were worried about this China plus one or reorganizing of supply chains. Was that really going to hurt a lot of the companies in China? And I think they're figuring out their way around that. That will probably end up being more successful in that than I think folks from the outside look. And then, look, there are going to be folks with the geopolitical rhetoric that goes on. There's certainly going to be, you know, some of our clients who say, well, I want ASEAN without China, and that's fine. We build portfolios for everything. But to be able to complete our offerings, we have to have a presence in China.
Right. Okay, I asked my last question before I open it to the floor, and also some online questions. So talk about investment. So just want to get your advice in terms of selecting investment going forward, like in this year. What would be your recommended pick in terms of asset class or geography or any ideas that investors should really pay attention to?
So remember, I think I have 18 investment teams. So when you ask me to say one, it's like picking a favorite child. Okay, so I'm just going to preface with that. But I have to tell you, I mean, I'm going to give actually a couple of areas where I just think it's incredible opportunity. Look at secondary private equity is a massive supply and demand opportunity. There was $6 trillion deployed in private equity. You've had about $150 billion in secondary PEs deployed and about another $110 billion raised. What's happening now is as companies are slowing down in IPOs, realizations in private equity portfolios have slowed down. The LPs, the limited partners who own those portfolios, because some of these things can go out, venture can go out 20 years. I think private equity is 12, 15 years. And they're sitting there and they need to recycle that capital. And so they'll go to a Lexington Partners and here's a real transaction, where it was a pension fund that said, I need $1 billion off of my book in 30 days. And so Lexington Partners can go in and pick and choose which vintage of those managers they want to buy, and they negotiate a discount. They had deployed 40% of their current fund at a 31% discount from today's marks at the private equity firm. And it's just because there aren't that many secondary managers out there who can do a transaction of that size. And so, prior to even this period, the last two funds at Lexington Partners performed in top quartile of private equity managers. So I think secondary PE is phenomenal. And oh, by the way, it doesn't have a J curve. You're getting a diversified portfolio, and it has half the duration of private equity. Second area I would just have to say is private credit. You could earn 5% cash in a money market fund. High yield is 7.5. I mean, the spreads are pretty narrow right now. So we'd go more towards investment grade if you were going to stay into the traditional assets. And then you've got private credit yielding 12.5, 13%. I mean, so it's a really, excellent spread there between the traditional and it's often better grade paper than high yield paper. And then real estate's a difficult one, but in the right sectors, real estate's still pretty appealing. Real estate's is a good investment in some places where you have inflation. And so, if you can be in logistics or things like data centers or supply chain management or multifamily in the U.S., for example, you have $3 to $5 million shortage in multifamily homes having been built. Those are still holding up pretty well. It's office and retail commercial space that are more challenged. So I think you can find good opportunities today. And then in equity markets, we're tending to be a little bit more comfortable on value than growth, although we'd say tech sector widening out beyond the Magnificent Seven, should be still a pretty interesting opportunity. So there you go. Those would be my first list.
I can see you try to be fair and equitable as much as
they'll complain.
You can.
I know they'll complain.
But don't worry. I know the business head here, and everyone has their turn to become the favorite child on a different day. And
That's right.
So it's just a matter of taking turn. Now, perhaps I will open the floor to anyone here who would like to ask questions, and then I can turn to some online questions. So first one is Tony.
Thank you. Well, thank you very much indeed for a very wonderful talk. And like you, I do believe that the future in technology would bode, I think, rather good or bad, one doesn't know. But it certainly bodes well for really finding new ways of making markets and new ways of finding and discovering prices. So that would be the future. I do have a question, though, something which bothers me, because I'm in the legal profession, and technology does bother all of us at the moment. Let me just start with a story. Many years ago, maybe in mid-90s, I was at Goldman Sachs, and I met Professor Fisher Black, who then did the very new computer system for finding risk and ensuring all the dealing desks at that time, in fact, knew all the VARs and so on and so forth. He was immensely proud of it, so well did management. But then he said one thing to me. He said, well, and then I asked him, can you trust all of this technology? Because AI at that time was science fiction. Mm-hmm. And I asked him, you trust all of this technology, what if it goes wrong? And he says, well, we have one final test, and that is the nose test, he says. If it doesn't pass the nose test, doesn't go through. Okay, let us then fast forward to the age of AI. I think sooner or later, you would find AI produces a solution which is so compelling that the nose test becomes diluted. And people who are less experienced, maybe people extremely experienced might do that. But then you run portfolios around the world, so many portfolios. Now, how do you then inculcate that proper nose test when the time comes, when AI becomes so compelling that people might even be afraid to put in their own judgment?
Well, one thing is, I've described this AI like this before, which is, and it came from our CIO of Franklin Fixed Income, which is you should assume that AI models today are like a really smart intern. They're going to give you a bunch of information, but you'd never want to trust their judgment. I think it would be a dangerous point to assume that you would ever really take out the human smell test. And I don't know what that looks like. I have to tell you, I was listening to, I met somebody, I was in India, and he was, we were at a joint lunch, and he runs a AI company that does robotics, but they're trying, he started talking about how you need to include organic matter and inorganic matter, and we really, that AI will ultimately be its own species. And I just kept thinking of Terminator, and it was really scaring me at that point. So, listen, that's above my pay grade as far as knowing and understanding how far that technology will ultimately go, and I do think we have to be careful. But I also think today, it's still very nascent. You cannot trust it. It will hallucinate over and over, and you do need to check with the smell test. So that's one. And then number two, back to the regulatory environment, the challenge is you want to be able to regulate it, and yet if you regulate it too much, you lose innovation and only the bad guys become experts at using it. So you have to ensure that you're allowing enough flexibility as this evolves. But I do think that, you always want to be able to have that level of intervention. And that person I was talking to kept saying, I said, well, aren't you worried? Couldn't it be like the Terminator? And he goes, no, we'll nurture them. The people will nurture them. I was like, yeah, I think that's what they thought was Skynet. so I don't know. I think we're far from that point today. But I also think you can't just say, well, because it's got these, there's these concerns, you can't evolve with it. You have to. And honestly, we'll focus on solving the problems in our company today and trying to provide the best solutions for our clients, leveraging AI as a tool in that process.
Thank you. Okay. Other? Yes, Angelina?
Thank you, Jenny, and thank you, Howard, for an amazing talk today. And Jenny, I love your views in terms of AI as well as being very pro Bitcoin and blockchain. What are your views of Asia Pacific? And you've talked about your acquisitions, all of which have operations in Asia. Will you, or do you have plans for Franklin Templeton to further grow in Asia? Grow in China or different areas, and hopefully grow in Hong Kong? And what recommendations, if any, could you give us in terms of from either blockchain or AI or things that you see that maybe Hong Kong can do even better, and how we can be even more pro-business?
Great. Well, first of all, I believe our office has grown. I'm looking for somebody locally since COVID. So we've actually, thanks, Tarek. So we've actually grown here in Hong Kong. I think some others have retreated, but we've actually invested more here. And for us, specifically with China, as I mentioned, we've had a long-time joint venture. We're hoping to buy out the rest of our joint venture and continue to see it as an important part of our strategy. I think the benefits to this region is, they talk about 1 billion people hitting the middle class in the next decade, 87% of them in Asia. So that's if you're in the asset management business, that is a good trend. And so we plan to be here to be able to bring products and capabilities to that growing middle class. So that's really exciting for us. And we grow with the opportunity. You know, we are always looking at different markets and trying to understand where you deploy more resources to be able to capture greater opportunities. And so we will continue to look around all of Asia. We're in quite a few markets, but to ensure that we're able to grow there. And then what I'd say from a regulatory environment, you know, I have been very impressed with the Hong Kong regulators with respect to the area of blockchain in particular, because they probably have provided the most clarity of any of the regulators out there.
Yeah, yeah. Okay, so yes.
Hi, Jenny. Welcome back to Hong Kong again. It's amazing to always hear all your insights, and also to see all the senior executives. You brought all of them, right? So really, really, really great. So my question is, again, around technology, right? Because I think everybody's talking about this right now. For a long time, we talk about number of jobs will be replaced because of technology. Now we've got generative AI. Specifically in the asset management world, we talk about disintermediation for a long, long time, all right? So more than 10 years ago, we talked about robo-advisory. Now the capabilities are much, much more advanced, right, than what it was before. I'd like to get your views in terms of what do you think is likely to happen, right? Because 10 years ago, we talked about asset managers taking center stage. There will be disintermediation. We will get better solutions for investors, lower costs, you know, so they will get access to asset management much more cheaply. It hasn't happened yet,
Yep.
especially in our world here in Asia, right? So it would be wonderful to get your views on this.
So first I'm going to, just with technology in general, there's always this fear when you have technological breakthroughs that we're going to eliminate all these jobs. And somehow we always find the next jobs that come out because our clients demand more from us and we create new things. And so I never worry about sort of the jobs. You know, in 1899, the head of the US Patent Office recommended that the patent office be shut down because everything that was ever going to be invented was invented. That was his view. So, you know, again, I think that in some of these new technologies, what we're going to find is we're just offering our clients a lot more. Now, with respect of disintermediating, so you eliminate the person in the process of investing. That is, in 1997, the cover of Business Week said the death of the broker, because the internet was going to get rid of the financial advisor, essentially, in the US. And sure enough, that didn't happen. What happened was the internet made the financial advisor that much better at their job in communicating with clients and connecting with clients. I feel, and what we tend to see, and it still remains to be seen about whether this next generation is different from the rest, but what we tend to see is people are good being self-directed and using robos and others when they don't have a lot of money. But when they save about 3 times, this is what I've heard, it's anecdotal, I can't cite a scientific report, but once they've saved about 3 times their income, their annual income, they then look for a professional manager. So they move. And we run a ultra high net worth business, and I can't tell you the number of clients that are perfectly capable of running their own money, but they realize it's not a part-time job. And they want to trust somebody to do it for them because they actually now have enough money to go do other things. So I still believe that person will be involved, and these tools will just make them that much more efficient. In the US, there's a software application called TurboTax, and TurboTax was going to eliminate all the CPAs who do everybody's taxes. Now, 99% of the users of TurboTax are the CPAs who use it to be able to handle more customers. So I look at a lot of these tools, because in the end, people still feel better connecting with another person. So I'm just a believer that will remain in there. And yet the value of these kind of robo opportunities, and ultimately what I think blockchain will do, is it's really important to get people saving when they're young, to start saving. So if you save, say somebody saves $5,000 a year from age 25 to 35, with just a 7% return every year, they will have more money than a person who saves for 30 years starting at age 35 to 65. You can run that math on spreadsheets. So that 10 years, think about that effect of compounding and how important that is for us to engage people when they're young to start saving. And so those types of robo-apps and ultimately tokenization and other things will at least get people in that mindset and the discipline of saving. And I think that's better for all of us, because if people can support themselves in retirement, that takes less of a tax on the system to have to support them.
Well, very interesting. That brings me to a question that I wanted to ask is, we talk about investment asset classes, geography. You mentioned investors. You're a global firm, you have clients all over the world. Do you see any differences in the preferences or the behavior of investors from different parts of the world, like Asian investor and American investor or European investor? Do you see in terms of product preference, in terms of their investment behavior, anything that interesting thought that you might share?
You know, I think most people have an outcome they're trying to achieve. So we have something called the Franklin Income Fund. My grandfather managed the Franklin Income Fund. My father managed the Franklin Income Fund, and my brother all managed, or my sister managed it at one point. And now we have a team of other people managing the Franklin. And it's been around for 75 years, because guess what it does? It generates income. Generates income from equity and income, and so and fixed income. And it's a great way. You get a little bit of upside with the market, and you get, you know, to cover yourself if you retire or whatever. We've brought that product to Asia. I think it's our fastest growing product here right now, because it has an outcome that people need. And so I think from how they get there probably changes a little bit. But what we're seeing, the big trend is, people are looking for investment portfolios to be designed based on outcomes, and you're almost creating sub-portfolios. We have something called the Goals Optimization Engine, which actually leverages AI to do dynamic rebalancing. And it is, you basically use it. So I might say, my number one goal is I want to retire, have enough money to retire with dignity. Number two, I want to help my children pay for their college education. And number three, if I really do well, I'd like that extra house on the beach. Well, number one, you know, it's a must-have, it's a nice-to-have, and I got to kind of keep a high-octane investment strategy. It's the only way I'm going to get that second home on the beach. And it's like a waterfall. So if I'm on track for the top, it adds more to the next two. If the market drops, it dials up risk, and it runs that portfolio differently than it would run the one that I'm trying to get the second home, because that one has to literally take on a lot of risk for me to achieve my goals. So the way in which you get there probably changes, but we're finding that we've really adjusted how we communicate from benchmarks and asset class a lot with clients to what exactly is the goal you're trying to achieve.
Okay, thank you very much. Darryl, you want to ask the final question? I think we have time for one more.
Thank you, Jenny. So good to welcome you back since you last joined our investment summit last October. So thank you so much. I want to pick up on the last D that you mentioned, which is decarbonization. So the thing is, how do you incorporate that in the overall strategy of Franklin Templeton? Sure. And you also talked about the importance of meeting the requirements and the needs of your customers. So, well, some people are big believer in the need to decarbonize and manage climate risk, but some other people simply deny it. So when you have two different forces or opposing forces in your clientele and as well as your stakeholders, how do you manage that?
Sure. So first of all, by the way, kudos to Hong Kong for your green bond that you did on blockchain, which I think blockchain, when we're talking about some of the benefits, in decarbonization, the ability to track all of these things and use, you know, sensors in the Internet of Things to inform the smart contract, I think that's going to be really important combination to achieve some of the goals on the green bonds. So here's our view, and obviously it's in the US that this is the most political issue as far as red states versus blue states. But our view has been, as active managers, our job is to evaluate all risks associated with an investment. And so environmental risks are risks in investment. the social risks, the governance risks of portfolios in different companies, those are all relevant to how you weigh it and to consider it in making an investment. So our view was we weren't worried about what the political noise is because we have a fiduciary duty to evaluate those risks. And then I think actually Europe's done a pretty decent job at categorizing the kinds of investments. So Article 6 is, I will consider those risks. Genuinely, any active manager who is worth their salt is doing an evaluation of those risks. And then the second is Article 8, which says, I'll lean into a certain type. I might want companies that are improving their carbon footprint. And so I'm going to lean into that. And so it's just a tilt in it. And then finally, Article 9 is impact. I am looking for this specific impact. I will only invest in green bonds or whatever it is. Our job is to provide all of those solutions to our clients and be able to have that menu such that our clients can choose what is important to them. And each of our investment teams, so we have a centralized group that focuses on sustainability. They provide data to the investment teams, but honestly, each of our investment teams are independent on how they use that data, what they'll consider in their investment decisions, and their proxy voting is completely independent. So we'll get different teams on, if it's a controversial vote, we've had different teams vote different ways.
Okay. Thank you very much, Jenny. I'm sure there are many questions out there as well, and I do have a few from the online audience, but unfortunately, I didn't have time to go through them because of time. And I do have some more questions, like what will be your next acquisition target? I thought it might not be appropriate for me to ask here. But anyway, today we have a very generous sharing by Jenny and offer a lot of insight to technology, to investment. Really thank you for your time and for the presence of your executive team here. Let's give a big round of applause to Jenny.
Thank you for having me. Thank you.